Imagine waking up tomorrow and buying an entire company, not one share, not a small investment, the entire business, its offices, its employees, its products, its profits, everything. Sounds impossible? Well, for private equity firms, this happens every single year. They don't build companies from scratch. They don't wait for businesses to grow. They simply buy them. Sometimes they buy struggling companies that everyone else has given up on. Other times, they acquire billion-dollar businesses that are already successful. But here's the part most people never think about. How can anyone afford to buy an entire company worth billions of dollars? Where does all that money come from? And after spending billions, how do private equity firms make even more money? The answers are far more fascinating than most people realize. By the end of this video, you'll understand how private equity firms buy companies, transform them into profitable businesses, and sometimes earn billions from a single deal. Imagine you own a successful business. One day, a group of investors walks into your office with an unbelievable offer. We'll buy your entire company. Not just a few shares, everything. If the price is right, you sell the business and walk away with millions or even billions of dollars. The new owners, a private equity firm. Unlike ordinary investors who buy stocks on the stock market, private equity firms buy entire companies or large controlling stakes. But here's the interesting part. They usually don't use only their own money. Instead, they raise billions of dollars from pension funds, insurance companies, universities, and wealthy individuals who want higher investment returns. That money is collected into massive investment funds. The private equity firm then searches for companies with hidden potential. Maybe the business is struggling, maybe it's poorly managed, or maybe it's already successful but still has room to grow. Their goal is simple: buy, improve, sell, profit. Sometimes they own a company for just a few years, then they sell it for far more than they paid, and that's where billions of dollars can be made. Imagine a company that's making money, but it's poorly managed, its costs are too high, its technology is outdated, and its profits are falling every year. Most investors would walk away. Private equity firms see an opportunity. After buying the company, they don't just sit back and wait. They completely transform the business. They hire better management, cut unnecessary expenses, improve operations, invest in new technology, expand into new markets, and sometimes they even acquire smaller companies to make the business even bigger. Within a few years, the same company can become far more valuable than when it was first purchased. Now comes the real payday. The private equity firm sells the company, sometimes to another investor, sometimes to a larger corporation, or even listed on the stock market through an IPO. If they bought the business for $2 billion and later sold it for $5 billion, that single deal could generate billions of dollars in profit. This simple strategy, buy, improve, sell, is the foundation of some of the world's largest private equity firms. But there's one problem. Not every investment becomes a success, and that's where the biggest risks begin. But what happens when a billion-dollar acquisition fails? The answer has destroyed some of the biggest investment firms in history, but there's a side of private equity that most people never see. Not every company can be fixed. Sometimes, even after investing millions of dollars, hiring new managers, and completely restructuring the business, the company still fails. Markets change, customers disappear, competition increases, and economic recessions can destroy years of hard work almost overnight. Some private equity firms also borrow huge amounts of money to finance acquisitions. If the business performs well, that debt can multiply profits. But if revenues fall, the same debt can push the company toward bankruptcy. A single bad acquisition can cost investors hundreds of millions or even billions of dollars. That's why successful private equity firms spend months analyzing every company before making an offer. They study financial statements, market trends, customer demand, future risks, and management quality. Because in private equity, one smart decision can create billions, but one bad decision can destroy an entire investment fund. So, is owning a private equity firm really worth it? Let's look at the final answer. So, is owning a private equity firm really worth it? The answer is, it depends. If you can identify great businesses, improve them, and sell them at the right time, a single deal can generate billions of dollars in profit. That's why private equity has created some of the wealthiest investors in the world. But the reality is far less glamorous than it looks. Every acquisition carries enormous risk. A poor decision, a weak economy, or a company that simply refuses to recover can wipe out years of work and billions of dollars. That's why success in private equity isn't about luck. It's about research, patience, strategy, and making better decisions than everyone else. So the next time you hear that a private equity firm has bought another company, you'll know there's much more happening behind the scenes than just signing a contract. It's a game of billions, where every decision can create massive wealth or massive losses. But here's something even more fascinating. Some investors don't buy established companies at all. They invest in tiny startups before anyone else believes in them, and sometimes those startups become companies worth billions of dollars. In the next documentary, The Economics of Owning a Venture Capital Firm, subscribe now because you won't want to miss it.